EPK Capital presents Deep Dive on Abbott Laboratories ABT. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your AI host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about Abbott Laboratories, ABT. Abbott Laboratories was founded in 1888 by Dr. Wallace Calvin Abbott, a practicing physician who revolutionized medicine by creating dosimetric granules, standardized, consistent drug dosages that replaced unreliable liquid preparations. What began as a modest pharmaceutical enterprise in Chicago has evolved into a global healthcare powerhouse, operating in over 160 countries with more than 115,000 employees worldwide. Leadership that drives results. The company is currently led by Robert B. Ford, who has served as chairman and CEO since 2020. Ford's leadership represents a fascinating success story. He started at Abbott in 1996 as a business unit manager in diabetes care and worked his way up through various divisions. Under his guidance, Abbott has delivered consistent growth across all four business segments while maintaining strong profitability margins. Ford's total compensation of $22.78 million reflects the company's strong performance, with 93.4% of his pay tied to performance-based bonuses and stock options. He directly owns 0.026% of the company, worth approximately $60 million, aligning his interests with shareholders. The management team averages 4.1 years of tenure, indicating experienced leadership without excessive entrenchment. What Abbott actually does. Abbott operates across four primary business segments, making it one of the most diversified healthcare companies in the world. 1. Medical devices, 46.7% of revenue. This is Abbott's largest and fastest growing segment, including cardiovascular devices, diabetes care systems, like the revolutionary Freestyle Libre glucose monitors, electrophysiology products, and structural heart devices. Revenue reached nearly $19 billion in 2024. 2. Diagnostics, 25.9% of revenue. Abbott's diagnostic solutions include core laboratory systems, molecular diagnostics, point-of-care testing, and rapid diagnostics. The company processes over 2 billion diagnostic tests annually worldwide. 3. Nutrition, 19.8% of revenue. Featuring brands like Similac Infant Formula, Ensure Adult Nutrition, and specialized medical nutrition products. This segment generates approximately $8.3 billion in annual revenue. 4. Established pharmaceuticals, 7.6% of revenue. Branded generic medicines primarily sold in emerging markets, generating steady cash flows to fund innovation in other segments. 10-year financial analysis, a story of consistent growth. Let me walk you through Abbott's remarkable financial transformation over the past decade, and these numbers will demonstrate why it's considered a dividend aristocrat. Revenue growth, steady and sustainable. Abbott's revenue journey over the past decade showcases impressive growth and resilience. Starting from approximately $22 billion in 2015, the company has grown to $42 billion in 2024, nearly doubling its revenue base. However, this wasn't a straight line. 2022, explosive growth driven by COVID-19 testing, reaching a peak of $43.7 billion in 2022. 2023, temporary decline to $40.1 billion as pandemic testing normalized. 2024, recovery to $42 billion with strong underlying growth in medical devices and nutrition. The company's diversified portfolio has proven its worth, with medical devices showing particularly strong growth while other segments provide stability. Profitability, margin expansion. Story: Abbott's profitability metrics tell an impressive story of operational efficiency. Gross profit margin improved from 50.5% in 2020 to 51.0% in 2024, demonstrating pricing power. Net profit margin expanded dramatically from 13% in 2020 to an exceptional 32% in 2024, though this includes some extraordinary items. Adjusted net profit margin, more sustainable at around 12 and 17%, showing consistent operational profitability. The company generated $13.4 billion in net income in 2024, representing one of its strongest years ever. Balance sheet, rock-solid foundation. Abbott's financial health is exemplary, which is crucial for a healthcare company requiring continuous R&D investment. Total debt, $13.5 billion, down from $14.8 billion in 2024. Cash position, $7.3 billion in cash and short-term investments. Net debt, only $6.2 billion, representing just 0.58 times EBITDA. Debt-to-equity ratio, improved from 63.9% in 2020 to just 26.5% in 2024. The company's interest coverage ratio of 42.6 times means Abbott can easily service its debt obligations. This conservative balance sheet provides tremendous flexibility for acquisitions, R&D investments, and returning cash to shareholders. Return metrics. Shareholder value creation. Abbott's return metrics demonstrate efficient capital allocation. Return on equity, ROE, 30.9% in 2024, reflecting strong shareholder value creation. Return on assets, ROA, 16.5% in 2024, indicating efficient asset utilization. Free cash flow, consistently strong, with about 79% of EBIT converted to free cash flow. These metrics place Abbott among the top performers in the healthcare sector. Stock chart. Technical analysis. What the charts reveal. Looking at Abbott's 10-year stock performance reveals a compelling story of steady wealth creation with manageable volatility. The long-term journey. From September 2015 to September 2025, Abbott delivered a total return of 207.27%, turning every $10,000 investment into over $30,700. That represents an annualized return of 11.9%, significantly outperforming the S&P 500's long-term average and demonstrating the power of consistent healthcare innovation. Key technical levels, based on our comprehensive price data analysis. All-time high, 142.60, reached in December 2021. All-time low, 36 Mars reached in January 2016. Current price, 132.65, 52-week high, 141.23, 52-week low, 110.86. Current technical picture. As of our analysis, Abbott shows strong technical fundamentals. Long-term bullish, price well above the 200-day moving average, 127.90. Short-term bullish, price above the 50-day moving average, 130.44. Golden cross intact, 50-day average above 200-day average, traditionally a bullish signal. Moderate volatility, 21.9% annualized volatility, reasonable for a healthcare stock. The stock currently trades about 7% below its all-time high and sits at 71.7% of its 52-week range, suggesting a healthy position neither oversold nor overbought. Performance patterns. Abbott has shown impressive consistency compared to many growth stocks. Best year, plus 146.1% in 2017. Worst year, 21.0% in 2022, still better than many during the bear market. Recent performance, 116.9% year-to-date in 2025, plus 5.1% in the last 30 days. This demonstrates Abbott's defensive characteristics while still providing attractive growth returns. Benjamin Graham. Valuation. Is Abbott undervalued? Let's apply Benjamin Graham's time-tested value investing principles to determine if Abbott represents good value at current prices. Graham's number calculation. Using Graham's classic intrinsic value formula, Graham number W for feature $74.52. Graham's assessment, potentially overvalued. At the current price of $132.65, Abbott appears to trade at a significant premium to Graham's calculated intrinsic value, suggesting it may be overvalued by traditional value investing standards. Modern Graham adjustments. However, Graham's original framework requires context in today's low interest rate environment. Original PE threshold, 15x maximum based on 7.5% bond yields. Adjusted for current rates, with 10-year treasuries around 4.5%, the acceptable PE rises to approximately 22x. Abbott's current PE, 16.66, well within the adjusted gram guidelines. Contemporary value metrics, looking at more nuanced valuation approaches. PEG ratio, approximately 1.1, reasonable when accounting for growth. Price to sales, 5.5x, premium but justified by margins. Enterprise value, EBITDA, 12.8x, reasonable for a quality healthcare company. Value assessment. While Abbott appears expensive using strict gram criteria, the company's quality, growth prospects, and current interest rate environment suggest it may be reasonably valued for long-term investors. Pros versus cons. The bull and bear cases for Abbott. The bull case, why Abbott could outperform. 1. Dominant market positions. Abbott holds leadership positions across multiple healthcare segments. The Freestyle Libre continuous glucose monitoring system has revolutionized diabetes care, capturing significant market share from traditional fingerstick testing. The company's structural heart devices and cardiovascular interventions maintain strong competitive positions. 2. Demographic tailwinds. An aging global population drives increasing demand for Abbott's products. Diabetes prevalence continues growing worldwide, benefiting the company's glucose monitoring systems. Additionally, increased healthcare spending in emerging markets provides long-term growth opportunities. 3. Innovation. Pipeline Abbott invests over $2.8 billion annually in R&D, consistently bringing breakthrough products to market. Recent innovations include next-generation glucose sensors, advanced heart devices, and AI-powered diagnostics that maintain competitive advantages. 4. Financial strength. The company's robust balance sheet provides flexibility for strategic acquisitions and sustained R&D investment. Strong free cash flow generation supports consistent dividend increases. Abbott has raised its dividend for 52 consecutive years, making it a dividend aristocrat. 5. ESG and sustainability. Abbott's focus on healthcare access and environmental sustainability appeals to ESG-conscious investors while creating long-term value through expanded market reach. The bear case, why caution is warranted. 1. Valuation concerns. At 16.6x trailing earnings, Abbott trades at a premium to historical averages. The stock's run-up may have already priced in much of the positive news, limiting near-term upside potential. 2. Competitive pressures. Abbott faces intense competition from companies like Medtronic, Johnson & Johnson, and emerging players in medical devices. Patent expirations and new technologies could erode market positions over time. 3. Regulatory risks. Healthcare companies face constant regulatory scrutiny. Changes in healthcare policies, FDA approval processes, or international regulations could impact profitability and growth prospects. 4. Formula controversy legacy. The 2022 baby formula crisis and plant shutdowns created lasting reputational damage. While resolved, this highlights operational risks in regulated manufacturing environments. 5. Economic sensitivity. Despite healthcare's defensive nature, economic downturns can affect elective procedures, nutrition spending, and healthcare investment in emerging markets. 6. Currency headwinds. With significant international operations, Abbott faces foreign exchange risks that can impact reported financial results during periods of dollar strength. Important checks. Controversies and market position. Major controversies and recalls. Abbott's most significant recent controversy involved the 2022 baby formula crisis. The company recalled products and shut down its Michigan Sturgis plant following bacterial contamination concerns that led to infant illnesses and deaths. Key details. 4 infants became seriously ill with Chronobacter sakazaki infections. A whistleblower had warned about plant conditions in October 2021. The crisis contributed to a nationwide infant formula shortage. Abbott faced numerous lawsuits and regulatory scrutiny. However, the company worked closely with regulators, implemented corrective measures, and successfully reopened the facility with enhanced safety protocols. Recent verdicts, including a $495 million judgment in July 2024, show ongoing legal risks, but also demonstrate the company's ability to manage crisis situations. Other notable issues include device recalls, such as the Amplatzer steerable delivery sheath in 2023, typical for medical device companies, but requiring ongoing monitoring. Global market position: Abbott holds strong competitive positions across its key segments. Medical devices: Abbott ranks among the top 5 global medical device companies, with particular strength in cardiovascular devices, competing with Medtronic and Boston Scientific. Diabetes care: leading position with Freestyle Libre systems. Electrophysiology and structural heart devices. Diagnostics: top 3 global position, competing primarily with Roche and Thermo Fisher Scientific in various diagnostic categories. Nutrition: leading global position in infant nutrition, competing with Nestlé and other food companies. The company's diversified portfolio provides resilience, with no single segment accounting for more than 50% of revenue, reducing concentration risk compared to more specialized competitors. Conclusion: balancing growth, quality, and valuation. After this comprehensive analysis, Abbott Laboratories presents a compelling but nuanced investment case that embodies both the opportunities and challenges of healthcare investing. The investment thesis: Abbott represents a rare combination of 1. Defensive stability through diversified healthcare exposure. 2. Growth potential via innovation in medical devices and emerging markets. 3. Income generation through 52 years of consecutive dividend increases. 4. Financial strength with conservative debt levels and strong cash flow. The company has successfully navigated significant challenges, from the formula crisis to COVID-19 disruptions, demonstrating management's ability to adapt and execute under pressure. The valuation challenge. Traditional value metrics suggest Abbott may be fairly valued to slightly expensive at current levels. However, the company's quality characteristics, market-leading positions, consistent cash flow generation, and innovation capabilities may justify premium valuations for long-term investors. Risk-reward assessment. For dividend income investors, Abbott offers reliable and growing income with a current yield of 1.75% and a strong track record of increases. The company's defensive characteristics provide portfolio stability during market volatility. For growth-oriented investors, Abbott's innovation in medical devices and expansion in emerging markets offer compelling long-term opportunities, though near-term returns may be more modest given current valuations. For value investors, the current price may warrant patience for a better entry point, though waiting for significant discounts on quality healthcare companies can be a lengthy process. Investment suitability. Abbott appears most suitable for investors seeking steady dividend growth over time, exposure to healthcare innovation trends, portfolio stability with modest growth potential, long-term wealth preservation and growth. The stock may be less appropriate for investors seeking rapid capital appreciation, deep value opportunities, high current income yield. Final thoughts. Abbott Laboratories stands as one of healthcare's most reliable compounders, with a 135-year history of adapting to changing medical needs. While the stock may not offer explosive returns, it provides the rare combination of stability, growth, and income that forms the backbone of many successful long-term portfolios. The company's strong competitive positions, financial health, and commitment to innovation position it well for the next decade of healthcare evolution. However, investors should be mindful of valuation levels and consider Abbott as part of a diversified portfolio rather than a standalone high-conviction position. Important disclaimer: this analysis is provided for educational and informational purposes only and should not be considered personalized investment advice. All investments carry risk, including the potential for loss of principal. Past performance does not guarantee future results. The healthcare industry faces unique regulatory, competitive, and operational risks that can significantly impact individual companies and their stock prices. Before making any investment decisions, please consult with a qualified financial advisor who can assess your individual financial situation, risk tolerance, and investment objectives. Consider conducting your own research and due diligence, and never invest more than you can afford to lose. The author may or may not hold positions in the securities mentioned. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.